I'm Dr. John Gatsi. I'm a senior lecturer at the Department of Finance, School of Business, University of Cape Coast. Currently teach finance-related courses, courses relating to oil and gas, precisely petroleum revenue management, and I also teach quantitative methods. Well, annuity is a very simple and basic principle. It deals with the stream of cash flows. Normally, we want to see cash flows or series of cash flow come regularly, and most of the time the amount in question are almost the same over a period of time. So if, for example, somebody is receiving at the end of each period 200 Ghana cedis over a 5-year period, and the 200 cedis come at the end of each month. 200 Ghana cedis come at the end of each month, and this payment is regular over the 5-year period. Then we can refer to the 200 Ghana cedis as an annuity. So basically, there are two things involved in annuities: regularity of the cash flow, either receipt or payment, and the amount that is involved is almost the same or is the same over the period in question. So that is what we actually refer to annuity. There are examples of annuities around us. When we go to the bank and take a loan, and the loan repayment schedule is prepared most of the time in such a way that you pay the same amount over a certain period of time until the loan is fully paid or fully amortized. That is a typical example of an annuity. So if, for example, the loan you have taken, you're supposed to pay over a 2-year period, and at the end of each month, they deduct 200 Ghana cedis from your salary. So the same amount of money is deducted over the 2-year period regularly, every month regularly. Then that qualifies to be described as an annuity. In some cases, too, insurance premium are also qualified to be annuity, and sometimes to contribution to pension, especially when over a period of time we do not see changes in the basic salary of people, and for that matter they contribute the same amount of money monthly over a certain period of time. Then that contribution qualifies to be described as annuity. Sometimes, so if you take our rent regime, the rent is the same over a period of time. Normally the person wants to take 2 years or wants you to pay over a 2-year period, then they can renew the rent agreement. So if the agreement is such that every month you are paying 200 Ghana cedis as your rent, then over the 2-year period, so long as you are paying regularly and the landlord or landlady is receiving that amount regularly, and the amount is the same over the 2-year period, then the rent also qualifies to be described as an annuity. Annuity itself can be divided into two. We have what you call ordinary annuity and annuity due. In the normal scheme of things, we want to receive or make payment at the end of period. So if you receive this stream of cash flow, which is the same over a period of time regularly, at the end of the period, then that will be described as ordinary annuity. But if the receipt or the payment of this series of cash flow we're talking about is done at the beginning of the period, then we are referring to annuity due. Normally, some people would like to describe the annuity due as annuity in advance. And some people also describe the ordinary annuity as annuity in arrears. Beyond that, annuity can also be divided into present value of annuity and future value of annuity. If we're talking about future value of annuity, what we're trying to do is we introduce what we call the future value interest factor of annuity. We multiply the future value interest factor of annuity by the constant or the regular cash flow. In our previous discussion, we were referring to 200 Ghana cedis. So if we are receiving 200 Ghana cedis at the end of each month, then if we want to find the future value of annuity, it's just the regular payment multiplied by the future value interest factor of annuity. If we are dealing with annuity due, then what the only difference will be that when we multiply the future value interest factor of annuity by the regular cash flow, then we again multiply it by 1 plus R, R being the annual interest rate. So we get there. So we can convert the ordinary annuity to annuity due just by multiplying it by 1 plus R. Again, we can have present value of annuity. And the present value of annuity only means that you are multiplying the constant or the regular cash flow by the present value interest factor of annuity. When that is done, then you get the present value of annuity. Again, we can convert the present value of annuity to present value of annuity due just by multiplying that by 1 plus R. So basically, that is what annuity is about. If you recollect the examples I was giving, so you will clearly realize that annuity is a basic concept or principle that is applied in insurance, pensions management, and management of finances in general. If you take the present value of annuity, present value of annuity is actually applied in the management of loans. So we have a loan amortization. So normally when people take loans, an amortization schedule is prepared for them to follow over a period of time to fully amortize or to fully pay the loan at the end of the loan period. You will realize that the schedule is prepared in such a way that at the end of each month or each year, depending on the situation, the same amount of money is paid by the debtor, which in this case we refer to as the installment. So you could see that installment is regular over the period and it's almost the same amount over the period. So it follows annuity, and that is basically the application of present value of annuity in managing the loan portfolio or to managing. So it could be used in the credit department of banks in preparing a payment schedule that should be followed by debtors to the financial institution. We also do apply annuities, especially present value of annuity, in valuation of bond or fixed income securities. So if you are valuing bond, for example, then there is an aspect that deal with the concept of annuity, and there is an aspect that deal with the concept of present value. So these are the areas that annuities are clearly applied. So as you can see, this is a typical amortization schedule that is being prepared. What is being shown is that the individual went in for a loan of 120,000 Ghana cedis over a period of 5 years. So within 5 years, he's supposed to finish paying the loan. The interest rate is 8%. That's the annual interest rate is 8%. So in that case, it is very easy to compute the installment, which is the regular payment, which follows the annuity. So in that case, you just divide the loan amount by the present value interest factor of annuity, and that gives you 30,054 Ghana cedis 85 pesos. So you will see that the installment portion, the same amount throughout. That follows the definition of annuities. But how is the table prepared, or the schedule prepared for the one who has come for the loan? So in the first year, he has a beginning balance, which is the loan amount or the principal, which is 120,000. Then you compute the interest of 8% on that 120,000, and that gives you 9,600. You add it to the loan amount, that gives you 129,600. You deduct the installment payment from that amount, which you're referring to the amount due. You get the ending balance of 99,545.15 Ghana cedis. The ending balance becomes, for the year one, becomes the beginning balance for year two. So that's why when you come to year two, you see 99,545.15, and you apply the 8% on it, and that gives you the 7,963.61 Ghana cedis. So you add it to the 99,545.15, and that gives the amount due for that year, and that is 107,508.76. You deduct again the same installment amount from this 107,508.76, and that gives you the ending balance of 77,453.91, and that becomes the beginning balance for year three. Then you apply the same principle throughout. So you will realize that at the end of the period, which is the year 5, you realize that the ending balance is dash or zero. Why? Because you have fully amortized the loan, or you have fully paid the loan per the schedule. The schedule is always prepared in such a way that at the end of the period, you should be fully paying the loan. Now, if you are not careful, two things may happen. One, at the end of the period where you should fully pay the loan, you may see that there is a small balance which is negative or positive. Now, if it is negative, it implies that you have overpaid. So if you take it from the perspective that millions of people come to the bank to take loan, and assuming that all of them, the calculation is done in such a way that by the ending period, they overpay by, let's say, 5 cedis. So over the 5-year period, you realize that the bank will be making a lot of free cash. So that is why we need to be very conversant with this. And again, if the payment is such that at the end of the period, there is a positive balance of 5 cedis, given the number of people who are come for loans, and then given the volume of loan that each individual come for. So over that period, it means that the bank will be losing 5 cedis. So that is why we need to pay particular attention in preparing this schedule, so that by the end of the period, the loan is fully amortized. So this is the typical application of amortization as we talk about. So you can do the same thing for bond valuation, but we want to just quickly talk about the issue of sinking fund. The sinking fund is actually established with two concepts in mind. The first one is that you can establish the sinking fund or create a sinking fund with an initial deposit. If you create a sinking fund with initial deposit, what happens is that it will reduce the regular amount that you should be putting into the account. But if you don't prepare the sinking fund with an initial deposit, that it means the amount that you should be putting in the account, whereas periodically over the life of the loan, in order to accumulate some money to be able to retire the loan, will be higher. So you reduce your burden of regular contribution to the fund by creating the account or the fund with an initial deposit. So if you look at this table is just demonstrating the issue relating to sinking fund. So if you look at that installment payment is what the one who created the sinking fund will be putting into the sinking fund periodically. That will be earning interest cumulatively over the period. So you see that at year one we have a balance, that 1,000 Ghana cedi. It means that we have created the sinking fund with a deposit of 1,000 Ghana cedis. The interest rate in question here per annum is 10%. So it means at the end of 1 year, you are earning an interest of 100 Ghana cedis. Then you have already computed how much you should be putting into the account. That is 500. So what will happen is that at the end of the period, this will be the cumulative amount in the sinking fund. That will be the 1,000 Ghana deposit plus the interest under the 1,000, which is that will become 1,001 plus the installment or the periodic contribution to the fund, which is 500. So you have 1,600 at the end of the first year. So the beginning of the second year, your principal or your balance will become the ending balance of the first year. That is 1,006. So the 1,006 will also earn 10%. That is 160 plus the 500 contribution. All will end up at the end of the period to be 2,260. So you continue the process until you come to the end. So what it means is that at the end of the fifth year, you'll be accumulating an amount of 4,663.06 to retire your loan. So normally, some people will create the sinking fund in such a way that the amount of money at the end of the period will equal the loan amount that they have taken, or to significantly reduce the burden of repayment. So actually, the sinking fund is actually a debt management tool that's to reduce the possibility of default, because when you incur you actually default, it damages your credit reputation and it increases your risk profile. So no business or no individual who is sensitive to these things would like to default. So that is how sinking fund actually work in managing debt. But the concept we are actually emphasizing within this is the annuity. We can also talk about the future value of annuity. Is also applied in what we call management of debt through the establishment of sinking fund. The sinking fund is just an account that is established with the aim of accumulating money over a period of time to repay loan, or to pay part, or to be able to actually pay part of the loan if it is not enough to fully pay the loan. In order to do that, you will need to be putting in the account some regular amount of money, and that regular amount of money also follow the future value of annuity principle. So you can see clearly that annuity is very, very important in the general financial management. Annuity is very important in managing debt, either from the perspective of following a schedule by the debtor, or the debtor trying to put in place a fund to be able to pay off the loan at maturity. Those of us who are following the Ghanaian situation, you will realize that I think about 2-3 years ago, the government of Ghana decided to put in place a sinking fund, taking some money from oil revenue to establish a sinking fund. The aim is that Ghana is supposed to use the proceeds from that sinking fund to amortize or to fully pay off the rest of the 2007 Eurobond that should be fully paid in 2017. So that was utilized as part of the management of that particular debt. So you will see that annuity is very important when you are establishing sinking fund to manage your debt. So these are very clear areas that annuities are actually applied in insurance, in pension funds, in financial institutions and management of debt in general.